Welcome into Phil's Tax Hacks and Other Retirement Facts with CPA and personal financial specialist, Phil Putney. Now let's get rolling with today's show. Hey everybody, welcome back into the podcast, Phil's Tax Hacks and Other Retirement Facts with Mark and Phil here to talk about the second part of a podcast we did a couple episodes ago, back on 187, episode 187. We talked about, mastering cash flow. And Phil, we talked kind of about, just expenses and just things that happen in retirement. So this time I wanted to finish up that conversation and do kind of understanding the income needs that change in retirement, right? Based off of, we kind of identified
the other side of the equation. So
yeah, we identified, the outgoing, right? Basically the expenses and things of that nature, things we could, the haves and the have nots and all that kind of stuff.
Right.
So let's get into the understanding the income side of it. So it's kind of part two of the series here that we're going to talk about. Is a couple of weeks ago. If you haven't subscribed to the podcast, good time to do so. We've got, I think we're on, what is this, like 191 or 92? We're almost at 200.
Yeah, I know. We're approaching 200. That's kind of crazy.
Yeah, but that's all right. I always love talking to you. So
yeah, good. I love it.
Yeah, let's get into it. We got a bunch of stuff to cover. So why is understanding your income obviously super important, right? Because cash is king, right? Income is king in a lot of ways for retirement.
Yeah, I mean, that's what retirement's all about, right? I mean, it's, you no longer have a paycheck coming in. So where's the money going to come from? And the biggest question usually comes up is, okay, so I've got these accounts. How does this exactly work? How do I get this money?
Right. Yeah. So I was going to say, what can happen if you don't have a good, clear picture of your retirement income? Well, then you're kind of winging it. And that's when you get yourself into trouble.
Absolutely. Yeah. If you don't have some kind of a plan as to how all these pieces come together. So how do you now meet the expenses? We talked about that. You know what you need. So where's that going to come from?
So what are some examples of different income sources? Okay. I think most of us can identify these, but let's just run through some anyway. So places where we might be getting our income in retirement.
When you think of income in retirement, I mean, income to me really is like a paycheck, right? That's what most people think of as income, money coming in on a regular basis. So from a true income standpoint, I mean, you're going to have Social Security. Everyone has that at a minimum.
Right.
Married couple, you'll have two. Depending on how you combine those benefits, could have a pension, so those are income type sources. Some people decide to work part-time in retirement, to kind of help bridge that gap for a few, years, months, whatever it is, as they're going into retirement, or just because they get bored, they want something to do. Gives them that outside activity, and some income. But those are what most people think of as income, traditional income. And I mean, you could have rental income. There's other types, quote unquote, income that could be coming in. Beyond that, then it's looking at the assets that you have, and I mean, it's an income stream, but it's taking distributions from some kind of an asset,
turning those
that's where
into
it gets
income.
Into more of a structure of how do you do that? How do you set that income up? So,
well, okay. So you identified a couple different places. So if we're talking about the diversification of, and that term gets used, and often we think about that just for our investments, but you can diversify your income streams and should, right? Ideally, we don't want to just have one income stream. My mom, unfortunately, right, she, due to some things we talked about on the show in the past, she's on Social Security only, right? That's her only income stream. That's not really ideally where you want to be. Unfortunately, that happens to many Americans.
Yeah, absolutely. Without planning, I mean, or, unfortunate
or bad mistake.
You find yourself in that scenario.
Yeah.
But ideally you want to have multiple income streams, not relying on any one, because things can happen, Social Security. There's a lot of talk out there that at some point they might have to restructure and change it unless they change how it works. And that's a whole nother discussion and show to get into. I think for most retirees, collecting Social Security now at that stage, I don't think there's as big of a concern for them. Could be.
No, I agree.
Younger workers, absolutely, it's got to change. It's going to be a completely different structure when you get it, how much you get, all that. It has to change to make it work.
Yeah.
But I mean, there are certain clients when you're looking at Social Security that they want to hedge against a what if worst case scenario, they have to cut it by 25%, because that's the math they're saying is if they don't change anything and it goes back and forth sometime in the 30 range, they would have to cut Social Security by 25% to make it work.
And so where do you get your shortfall at, right?
Right. Well, so that's something you have to kind of wrestle with yourself and your advisor to say, okay, do I want to build that stress test into my plan that if that happens, am I able to still live the retirement that I anticipate if I have a shortfall for Social Security? So that's where diversification comes into play. I mean, if you rely too heavily on one source of income, if go sideways with that, then you better have a plan. Pensions, kind of the same concept, where pensions are funded for the most part, but at the end of the day, that shortfall is then backed by the company. And if something goes wrong with the company, ultimately they might go under, then the Pension Benefit Guarantee Corporation, PBGC, steps in, and you're not going to get 100% of your pension.
No. Well, I mean, Social Security, it's a pension. I mean, for,
effectively,
effectively, right. I mean, it's, or an annuity. Some people, I think it even says annuity on the check.
Yeah. I mean, it's
and so it's backed by the government, and so in a lot of ways, they're not making good decisions in a lot of places. So let's talk about guaranteed income versus non-guaranteed, right? So guaranteed would be, obviously like Social Security, ideally, and it always has been till now anyway, or until maybe later, we'll say, as you just mentioned. But if you're working for one of the big three, and you have a pension, it's guaranteed, right? That's probably the category we would put that in. Yes.
I mean, if you look at guaranteed income, it's guaranteed by somebody outside of, it's not just your own investment, right? So there's some third party that's backing it. So Social Security is the government. Pensions are going to be assets they have, but ultimately then that company. An annuity is another form of a guaranteed income backed by the insurance company. So that's a little different in that you're funding it with your assets, but ultimately then shortfalls, if any come up, are backed by the insurance company. So those are going to be guaranteed type of income. And sometimes clients will refer to it as mailbox money, right? It's money that comes every single month. It's a check that shows up in the mailbox, proverbial check. I mean, reality
it's
is
probably
most people
digital,
get an ACH into the bank account, direct deposit once a month, like Social Security. But I mean, it's that monthly money that you don't have to worry about theoretically. I mean, again, we talked a little bit about some risks that you have to hedge against and understand, but it's not market dependent. Let's put it that way.
Yeah. And that's your non-guaranteed is your stuff is the assets you've accumulated and where you're generating it. And to that point, the market is not guaranteed. So having your 401k completely, in large cap is not guaranteeing you a 10% return. Even if it does for a number of years, it's no guarantee.
Yeah. And that's where you get into the non-guaranteed type of income is to your point, back to your assets based on the market and how you're invested, things are going to go up and down. If it's too conservative, are you not keeping up with inflation? So you're spending down assets faster than is growing and you might run out. If you're too aggressive, I mean, you're getting into too much volatility, then you get into the sequence of returns that we've talked about before, where, on average, you might have a higher return, but the reality is when you're spending from an account that has that high volatility, 2 bad years can dramatically change the plan.
And that's where
so it's not going to be guaranteed. So you have to really understand, what is the mix of those two? And everyone's a little different. I mean, some of that comes down to comfort. How much of your income source do you want to be backed by a guaranteed? So sometimes people look at it like, well, here's my absolute have to haves, right? I mean, this is
which we talked about in the other episode. Yeah.
If I mean, worst case scenario, I have to cover housing, right? I've got to have a place to live. So whether that's a mortgage or rent or, utilities and insurance and property taxes, maintenance, everything it costs to live where you're at.
Yeah.
Whatever that is, food, clothing, anything that you want to put into that absolute need. Guaranteed income is a lot of times
what you want that to
cover that.
Right. Exactly.
And again, some of this comes down to preference. I mean, I don't want to say ideally, but for I want to say maybe more of a comfortable retirement, having those kind of expenses covered by a guaranteed source is a good option.
Yeah.
Because then you don't have to worry about it. I mean,
it kind of helps you sleep and feel better.
Sideways, exactly. hey, I'm covered. I know I'm going to get enough every month coming in to cover these basics. On the guaranteed side, so one of the concerns to pay attention to is inflation, because
Right. Yeah.
oftentimes guaranteed income doesn't have an inflationary adjustment, or maybe not as much as what inflation is. Pensions, most of them, at least
Right.
private pensions, don't have an inflation adjustment. So it might look really good up front, but long term, 5, 10, 15 years down the road, I mean, that's covering less and less of what the expense is. So,
Well, and people have heard that term paychecks and playchecks, right? I think
yep,
it's Tom
yep.
Hegden, maybe. I think
Tom Hegden, yeah.
Yeah. And so obviously, your paycheck, maybe that guaranteed portion, which you kind of were saying, is the things you want to make sure you're covering this is what I need to live. And then your playchecks, which typically is coming from your asset pull down.
Right.
That's where you're kind of doing the vacations and the travel and the, whatever the case might be. But at some point, right, you are having to shore up from your assets, which is why we're saving money into these accounts for longevity and for retirement. So when to pull them and being properly weighted, right? Because you don't want to be too reliant on any one income source or too weighted in that area. Because if let's say you're pulling, and that's where some strategy like in Social Security even comes into play, right? When you're working with clients, because why take money from your assets if we can be using Social Securities? Maybe for person A, it makes more sense to do a certain strategy with the Social Security, and that's where they're getting the bulk of their money from earlier on. Right. And then later on, they go to their pile, right? So everybody's a little different that way.
It comes down to having a plan, because there's pros and cons to both sides of it. I mean, in my book, at least, you can have too much guaranteed income. The challenge that becomes there is, if you maxed out Social Security, that's awesome. You get the biggest Social Security benefit coming in. Now you've got a pension. And if you've saved well, now you've accumulated assets in those retirement accounts, and all of a sudden at required minimum distribution age, so 73 today, you might have way more income coming in than you really need, which now you've got a significant tax burden the rest of your life. So I mean, that's kind of the negative, the downside of having too much income. And frankly, that's one of the reasons when we were looking at pensions, explore that concept of the lump sum. Not to say that's the right option for everyone by any means. There's a lot of factors that goes into it, but the tax side of the equation is a big piece of that, because one of the ways to help bring that income down to what you need, not getting forced to take all this extra money, pay all these taxes that you might not have, is take that lump sum. Now it's an asset. You might have to take a required distribution, but typically that required minimum distribution on the lump sum amount is going to be less than what the pension is. It's a matter of understanding your scenario. Like we talked many times, there's all these moving pieces. Everyone has similar pieces, but everyone has a different strategy in how those pieces fit together.
Well, so maximization really of your guaranteed income sources and your non-guaranteed income sources is really going to be the crucial piece. And how do you go about maximizing that, right? So for many people, if you have been in this DIY mode, and we've been talking about that a lot for the last number of episodes, because it's been easy to do for the last number of years, but transitioning to retirement, even if the economy was still screaming along like it was in 19, right? It's still a different animal in the preservation distribution phase than it is in the accumulation. And that's a part that I think people don't really get until it smacks them in the face, right? It's like the Mike Tyson bit. Everybody, has a plan till they get punched in the mouth. Right. And, you start to realize, oh, crap, like you just said, like taking this money out of this is going to affect my Social Security and the taxation of Social Security and so on. So having an optimized strategy really is crucial for retirement, because it's just more complicated than we realize.
Yeah, I mean, I always say our strategy is to maximize income, minimize taxes, because at the end of the day, it's the net amount that you keep. It doesn't matter what your income is. I don't care if you're netting 150 a year between all these benefits. If you're only getting 100 out of it because you're paying a third of it to the government, if we can mix that around to where you're only getting 110, but you're still netting 100, and that's even a better scenario.
And people go,
now we minimize that tax exposure.
Yeah.
So,
well, people listening, Phil, might be like, well, yeah, duh, right? I mean, that seems like basic stuff, but it's the implementation of how to do it, which starts to elude us, right? And that's where turning to professionals like yourself, especially as a CPA, you've been dealing with taxation and those kinds of animals for, 30 years, right? So it's again, it's just different to understand how to do it. And I think that's the importance of podcasts, things like that, giving people the ideas to start thinking about, hey, how important is it that I get a maximization strategy on my incomes, guaranteed income sources versus my non-guaranteed? And then how does that affect my taxation?
And run scenarios. I mean, it's
stress tested.
The challenge that I see with most people as they approach retirement, decisions they're making are based on, well, so-and-so at work did this, or
right.
I heard that, or I read a blog that said this, or I listened to a podcast and they said, oh, I should do this.
Yeah. Phil said,
I don't know. I mean, I'm telling you, here's the moving pieces and I can give you examples of how they work, but most clients, it's a little different, right? I mean, a lot of clients are going to be similar in certain fashions, depending on assets and income, but yet how you blend those together for you and what your preference is. I mean, if you want more guaranteed income, that's great. Understand how that plays out into your plan long-term. You're shifting, some of that risk to somebody else. You're going to lose some upside potential from a market.
Yeah.
Benefit to the guaranteed income is it helps hedge the longevity risk, because we've talked before about the different risks, and longevity is that risk multiplier, because the longer you live, all these different risks that you face start to compound. So, I mean, it is that balance. I mean, don't rely too heavily on just your own assets, because if you end up living to 100, well, do you have enough?
Yep. There you go.
Some people do, but have a plan. Don't just jump into this based on something you heard.
Well, so guaranteed income versus non-guaranteed, the right weighting, the right strategy for maximization of each, and then how they're going to affect each other. That's important to identify, right? So make sure that you've done that. Make sure that you're identifying the outgoing expenses and the haves, the have-nots, the things that you got to have, and then how to get all that covered. That's the important part of getting a good strategy in place. And so if you need some help, reach out to Phil, give him a call, get on his calendar, whatever you'd like to do, have a conversation or talk with a professional advisor in your area, whatever that case might be, but certainly take some action. Phil is a CPA and a personal financial specialist, and he's been helping families for, like I said, 30 plus years. So get on the calendar, give him a call, have a conversation. 248-888-7530 is the number to call. It's on the screen if you're checking us out on YouTube. And don't forget to subscribe on YouTube or Apple or Google or Spotify. And you can find all of that at philstaxhacks.com. That's philstaxhacks.com. Thanks for hanging out, buddy. I always appreciate it. And I'll see you next week.
Good day.
All right. We'll see you next time right here on Phil's Tax Hacks and other retirement facts. Make sure you understand those income streams. We'll see you next time.
Phil? Investment advisory services offered through AFS Wealth Management. The content of this program is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. Investments and/or investment strategies involve risk, including the possible loss of principal. There is no assurance that any investment strategy will achieve its objectives.